Hello and welcome to my show, Searching for Integrity. My name really is John Smith, and I'm searching for people with integrity. Why? Because our country suffers from IDD, integrity deficit disorder. We have items today that we need to give good thought to, either that behind us, that for the future. I'm looking at items such as the economy, inflation, recession, and our own culture and consequences of therefore and the worst. I'm going to open here with an item, and it's about the Fed. And the Fed flopped in trying to predict 20 and 22. Persistent inflation and the market sell-off humble investors as they look to new year. Almost everyone on Wall Street and in Washington got 2022 wrong. Federal Reserve expected 2021's inflation such surge to be transitory. It wasn't. Core inflation climbed to a 4-decade high this past fall, nearly tripling the Fed's full year forecast. Top Wall Street analysts predicted markets would have a so-so year, but they didn't. With just a few trading days left in 2022, it's like today is the last trading day. The S&P 500 is down 19%, and of course, for its biggest annual loss since the 2008 financial crisis. Bonds are headed for their worst year on record. The extent to which many investors, analysts, and economists were wrong-footed was left many looking at the coming year with a sense of unease. The big debates of 2023 are already underway. The Fed has signaled it expects to keep raising interest rates, and yet traders have been pricing in rate cuts. Company executives are sounding the alarm about a potential recession. My economists at subbanks, including Goldman Sachs, Credit Suisse, and see the U.S. economy avoiding a downturn in 2023. If there's a lesson to be taken away from the past 12 months, some investors and analysts say it is this: be prepared for more surprises. And I agree with that. We're all approaching the coming year with a certain level of humility. And Christopher Smart, Chief Global Strategist and head of the Barings Institute Investment. Like many other strategists, Mr. Smart had expected inflation to moderate in 2022. But he didn't foresee the Russian would invade Ukraine, sending oil prices and energy shares briefly soaring. He also didn't anticipate how long China would stick to its zero COVID policy, which prolonged supply chain issues for companies around the world. You can always say in retrospect, you knew those were risks, but those were thought of as unlikely going into the new year. So what does Wall Street consider unlikely next year, 2023? Right now, it appears to be another pickup in inflation. Roughly 90% of investors expect global inflation to be lower within the next 12 months. According to Banks of America Corp's December survey of fund managers. That is the highest share in the survey's history. Growing confidence that inflation might have peaked as many investors betting on market reversal in 2023. Fund managers reported having a larger than average share of bonds in their portfolios for the first time since 2009, according to Bank of America survey. In other words, many investors are counting on waning inflation to make this year's loser, bonds, one of next year's big winners. I think if you're a betting person, you have to conclude from the data that inflation is coming down, said Nancy Taylor. Fed Chairman Jerome Powell has said it's too early to conclude that inflation has peaked. But Mr. Tangler, among others, is skeptical. Prices for everything from airfare to used cars to shipping have dropped in recent months. Mr. Tangler said that was helped consumers become more optimistic about the outlook for the economy. Data on Wednesday showed consumers' expectations for inflation in the year had fell to the lowest level in more than a year in December, while their level of confidence rose to an 8-month high. Bond traders have taken note, and one sign that many believe the Fed might not have much further to go on its rate increases. The real yield on the 2-year Treasury was at 4.32%. My. On Friday, up substantially for the year, but now more than 1/3 of a precision point from its November peak. Shorter terms yields tend to track traders' expectations for monetary policy, moving higher than traders anticipate the Fed raising rates and falling when they expect the Fed to start to pause or pull back. It won't go down in a straight line, but I do think inflation will surprise many on the downside, whose firm has been putting more money into risky assets, such as stock in recent months. Others remain unconvinced. The past year's twists and turns have made them wary of second-guessing the Fed. If anything, it pays to question what the crowd believes has become the consensus, they say. Fund managers surveyed by Bank of America say high inflation tanks on the top tail risk to markets, followed by a deep local recession and central banks keeping monetary policy tight. In market parlance, tail risks are generally negative events that investors view are unlikely to happen. The market has continued to believe that each interest rate hike is hopefully one of the last ones, even though the Fed keeps telling markets it's not. I think if you fight the Fed, then you do so at your own risk. That's true, but I don't think that things are going to get well anywhere quick this coming year, 2023. Really much, too much. Okay. Here's one from economists. Economists now expect a recession, job losses by next year. The U.S. is forecast to enter a recession in the coming 12 months as the Federal Reserve battles to bring down persistently high inflation. The economy contracts and employers cut jobs in response, according to Wall Street Journal's latest survey of economists. On average, economists put the probability of a recession in the next 12 months at 76 degrees, up from 49% in July's survey. It is the first time the survey pegged the probability above 50% since July 2020. In the wake of the last short recession. Their forecasts for 2023 are increasingly gloomy. Economists now expect gross domestic product to contract in the first 2 quarters of the year, a downgrade from the last quarterly survey, whereby they penciled in mild growth. On average, the economists now predict GDP will contract at a 0.2% annual rate in the first quarter of 2023 and shrink 0.1% in the second quarter. In July survey, they expected 0.8% growth rate in the first quarter and 1% growth in the second. Employers are expected to respond to lower growth and weaker profits by cutting jobs in the second and third quarters. Economists believe that non-farm payrolls will decline by 34,000 a month on an average in the second quarter and 38,000 in the third quarter. According to the last survey, they expected employers to add about 65,000 jobs a month in those 2 quarters. Forecasters have ratcheted up their expectations for recession because they increasingly doubt the Fed can keep raising rates to cool inflation without inducing higher unemployment and economic downturn. Some 59% of economists say they think the Fed will raise interest rates too much and cause unnecessary economic weakness, from 45% in July. Still, forecasters expect the labor market to weaken in the months and years ahead. They predict the unemployment rate, which was 3.5% and 3.7% in December, 4.3% in June 2023. Economists' average forecast for the jobless rate at the end of next year is 4.7%. And they expect it to stay broadly at that level. While 4.8%, almost 5%, unemployment rate is low, historical comparison, and indicative of the current worker shortage. The Federal Reserve is choosing between the lesser of two evils: take a recession with a rise in unemployment today, or risk a more corrosive and entrenched inflation taking root, said KPMG. The risks of a misstep are largely given the sense that low rates likely papered over, she said. The past few years have been volatile in the U.S. economy, and it faced shocks, including the COVID-19 pandemic and Russia's invasion of Ukraine. In 2019, before the pandemic hit, the economy grew at 2.6%, GDP contracted 1.5% in 20. Bounced back strongly in 2021, posting 5.7% growth. This year, as consumer and business grapple with high inflation and supply chain issues, economists expect the economy to eke out a growth of 0.2%. That's a low, a real low one. This is really something, you know. What we thought we were going to get, we didn't get it. What we think we're going to get this next year, we're not going to get it. This inflation pain you don't see. Definitions of middle class miss one final factor that shows how much price hikes hurt Americans. Official statistics don't capture the pain and inflation of many Americans. That's because there's something wrong with how we define the middle class. Consider two hypothetical Americans, John and Jane. Both have been stung by high gasoline and food prices, as well as by higher interest on their credit cards. John, a 67-year-old homeowner who gets $50,000 a year from a pension and Social Security, is managing. Jane, a 35-year-old renter with two children, young children, has a job paying $50,000, but is dipping into her small savings to pay her bills. Most analysts would call them both middle class, but it doesn't feel that way to Jane. Problem is that popular definitions of the middle class focus on income. If you make whatever measure considers average, you're in the middle class. But this definition ignores a difference between John and Jane. How much of their income is eaten up by necessities? Far more American households earn middle class income than enjoy a middle class lifestyle. In a recent RAND study I co-authored, we defined middle class households as those who spent 40%, 90% of their after-tax income on necessities: housing, food, clothing, transportation, education, child care, health care, and personal care products such as shampoo and toothpaste. We found that 1/3 of middle income earners and disproportionate share of those who are young, Black, Hispanic, and single parent households couldn't have a middle class lifestyle. Inflation makes the problem worse. In a separate analysis, my colleagues and I applied our study's definite in consumption profiles from 721 to pre-inflation 1-year inflation rates separately for food, education, healthcare, housing, personal care, transportation, apparel, and child care. We found that the middle class grew last year, but for all the wrong reasons. If middle class households don't cut back on some of those things or get better paying jobs, roughly 7.5% well, in working class under our model, at 10.7%, 12.7% of the upper class well fell into the middle of class. Single parents, renters, younger adults, those without college degrees, and Black and Hispanic households were all more likely have been pushed out of the middle class by inflation. Because of how inflation rates, this is an important point, because inflation rates differ across goods and services, the lower the household's income, the harder inflation hit. For middle class households, the percentage of after-tax income spent on necessities jumped from 60% to 65%. But upper-class households, the shift was from 26 to 28%. Working-class households already needed 108% of their monthly income to cover the basics in 2021. In 2022, it was 118%. They are all dipping into savings, getting help from relatives or safety net programs, or going into debt. Yet traditional definitions of the middle class won't show you much effect from inflation when official income statistics for 2022 are released. Incomes are slow to adjust over time, but behind these statistics, costs are piling for many middle class households, making life harder. It should be no surprise that inflation topped the list of voter issues this past election cycle. More Americans are finding that their middle class aspirations are teetering. Not very well, I would say. Here's another important thing that has occurred recently. The back end of an omnibus. We had a big 1.7 trillion pressed by Biden rather. And it's going to be just like the COVID, where all that money came out and it was thrown in places that nobody knew what to do with it, so they spent it. They keep spending and buying and buying and buying. And guess what? They ran out of money, and now all these items are higher because they were inflationary. Let's talk about Senate Minority Leader Mitch McConnell said this week he was pretty proud of the 1.8 trillion plus omnibus the Senate passed Thursday, since the GOP was able to achieve, essentially, all our priorities. That, America, is why Republicans are in the Senate minority. and why they arguably deserve to stay there. Never has Washington contemplated such a monstrosity. If a satirist set out to describe a once admirable institution in decline, its members, cheerfully passing off the laziness, secrecy, cowardliness, and graft as success, it will be hard to compete in what these week's Senate show. The omnibus is everything that is broken in D.C., dumped in one steaming pile. Congress has this omnibus only because Democrats wasted the year chasing Joe Biden's Build Back Better agenda, while Republicans helped waste more than semiconductor payouts and other unnecessary legislation. The Senate couldn't rouse itself to pass a single one of its 12 annual spending bills. Pretty much the same only deadline Congress hit this year was the cutoff for submitting thousands of earmark requests for home state pork priorities. Interesting. A handful of powerful leaders took advantage of this dilatory behavior by using it as an excuse for disappear last minute into a smoke-filled room and conjure up timeline, number for funding, finding no votes, no debate. Other leaders then disappeared to write the bill in secret. 4,155 pages of it. It was unveiled in the dead of Monday night with initial plans for Wednesday's passage, the better to ensure nobody would know what's in it or what's attached to it. Past omnibus at least confined themselves to funding everything under the sun, especially monuments to super appropriators like Alabama Republican Senator Richard Shelby. This omnibus has also become a vehicle for Congress wanted to pass this year but didn't. Those aren't small changes. And an overall of retirement savings rules, cosmetics regulation, electoral count act form, major changes to health care. For all we know, there's a provision creating 12 new cabinet positions. We might find out next year when someone has time to read it. Want to know your senator approves of authorizing Food and Drug Administration or killing off of drift net fishing operations, or letting athletes and service academics get a waiver to play professional sports. Good luck. Members of both parties will say they voted for the turkey sully to avoid a government shutdown, and they'll duck questions on the other hand. Lucky them. Zero accountability, only this isn't luck, it's by design. Senate Republicans spent the week telling the public there were only two options: sign off earmarks, bad policy, and Democratic demands for huge increases in domestic spending on top of $4.5 trillion in the past 2 years, or lose 10% increase in defense dollars. We can add dishonesty to the list of transgressions. The GOP could have insisted on zero domestic increases and dared Democrats to own a shutdown and the loss of military readiness. But who wants a spending fight when we can simply spend? That's a central problem for Republicans, even if they don't want to admit it. They haven't shown a whiff of interest in their physical restraint since the early days of Paul Ryan's tenure as House Speaker. Their majorities broke the bank during the Trump administration, enabling Democrats to point to deficits as reason to resist further tax reform. They held hands with the left to partake in 5 COVID ballots in 2020 alone. They joined again to pass Mr. Biden's infrastructure bill and the semiconductor slush fund. Members of this new, supposedly responsible Republican House majority weeks ago voted to keep the earmark gravy flowing. Voters in 2010 put Republicans in charge of the House to serve as a brake on the Obama administration. Next year's housing majority is no guarantee of a repeat. Democrats have figured out the bait for the bipartisanship and the promise of dollars, and today's Republicans party bites every time. 18 Senate Republicans voted Thursday for the ugliest, least transparent spending bill on record. As Republicans scratch their heads over their disappointing midterm, they might consider that voters don't see much of a defining difference with Democrats. The real scandal of the holdouts to House Republican leader Kevin McCarthy bid for Speaker is that they are stomping on an important message. A far bigger and more serious group of House conservatives are appalled by the practices that lead to omnibuses and want changes to require the House to return to regular order. Committees votes, amendments, debates that would return and focus on fiscal discipline, with members, again, subject to transparency and accountability. But Reps Andy Biggs and Matt Gaetz are more interested in grandstanding than actual victory. The battle helps Republican House porksters ignore substantive demands by casting the race for Speaker as a fight over personalities. It enables several Senate Republicans to justify their mess of omnibus on the grounds that House Republicans can't be trusted to do better. Right now, neither chamber can. Your government at work. Well, I'd say those guys are getting, what is it? Yes, it's not good. Here's an article, or I guess a happening, I should say. Why so many accountants are quitting. Even some accounting majors don't want accounting jobs. How do you think of that? My. More than 300,000 U.S. accountants and auditors have left their jobs in the past 2 years, a 17% decline in the dwindling number of college students coming into the field can't fill the gap. The exodus, driven by deeper workplace shift, the baby boomer retirements. Young professionals in 25 to 34 range, mid-career professionals between the ages of 45 and 54 also departed, high numbers in 2019. Huge gap between companies that need accountants and trained professionals has led to salary bumps and more temporary workers joining the sector. Once upon a time, I was a CPA, and it was hard. It was hard. And all the stuff that you had to keep up with was just almost, it was overwhelming at times. One student listening to certain universities were saying to themselves, I don't want to do all that. I was a little scared of it. I'm not going to lie. It's something that only a few can do it, and it's a shortage for sure. And I think I'll probably give this some more timing on nexting. My word, nexting, when I'm back next. So let me do this. Let me thank you for my searching for integrity, peoples, listeners. I'm so glad that you take the time to tune in to get some information that you understand. I try to give it the best I can, and I hope that you'll do the same in the future. So thank you very much, and thank you again, listeners. So long, and happy trails to all.